Between the first quarter of 2022 and the end of 2023, the Bank of England raised the base rate 14 consecutive times, a monetary tightening cycle designed specifically to cool an overheated economy and, by extension, asset prices. Yet, according to ONS data from the fourth quarter of 2023, average private rental prices in London did not cool, but rather accelerated by a staggering 6.8% annually, the highest rate since London records began in 2006. The standard economic playbook suggests that when the cost of borrowing becomes punitive, housing costs should eventually plateau or fall as demand is destroyed. In the capital's rental sector, the precise opposite occurred. How does a market so heavily reliant on leveraged capital manage to post record-breaking price growth precisely when that capital becomes historically expensive? The answer lies not in a sudden, inexplicable surge of tenant wealth, but in a fundamental structural mismatch between mortgage market mechanics and tenant demand. To understand this anomaly, we must look beyond the headline figures of rising rents and examine the underlying machinery of landlord financing. The private rented sector in the United Kingdom is largely underpinned by buy-to-let mortgages, heavily dependent on loan-to-value ratios, or LTVs, which measure the mortgage amount against the property's appraised value. When interest rates were anchored near zero for the better part of a decade, landlords could maintain high LTVs and still generate comfortable monthly profits. However, the rapid escalation in gilt rates, the yield on UK government bonds, which dictates swap rates, and consequently fixed-rate mortgage pricing, violently disrupted this equilibrium. This sudden spike in the cost of debt triggered immediate yield compression across the sector. Yield compression occurs when the income generated by an asset fails to keep pace with the rising costs of holding that asset, effectively squeezing the investor's profit margin to zero, or worse, into negative territory. Our proprietary models, updated last month, suggest that a standard two-bedroom London flat purchased in 2019 at a 75% LTV would have seen its monthly debt servicing costs more than double upon refinancing in late 2023. The intuitive assumption is that landlords facing such punitive refinancing costs would simply sell their properties, thereby flooding the sales market and driving down prices. While some certainly did exit the market, the mass exodus predicted by mainstream commentary failed to materialize in the capital. Instead, a significant cohort of property owners opted to pass the entirety of this new, elevated debt burden directly onto the consumer, testing the absolute limits of tenant affordability. Examining land registry data from January 2024 reveals the stark geographical disparity of this debt transfer strategy. In prime commuter belt areas like Bromley and Waltham Forest, where family homes dominate the rental stock, landlords successfully pushed through rental increases averaging 8.2% year on year. Tenants in these boroughs, facing their own cost of living crisis, absorbed these hikes not out of financial capacity, but out of absolute necessity, trapped by a severe lack of alternative accommodation. This localized supply drought is not a recent phenomenon, but rather the cumulative result of successive fiscal policies aimed at dampening buy-to-let speculation. The introduction of the 3% surcharge on stamp duty land tax, or SDLT, a tiered tax levied on property purchases, fundamentally altered the investment calculus for prospective landlords back in 2016. By significantly increasing the upfront transaction costs of acquiring a second property, the Treasury effectively choked off the pipeline of new rental supply entering the market. The shadow of that SDLT surcharge still looms over the current market architecture. Because fewer new landlords have entered the sector over the past 8 years, the total pool of available rental properties has stagnated, leaving the market entirely unprepared for demographic shifts. As the post-pandemic recovery took hold, the capital experienced a sharp demographic rebound, with international students, returning corporate expatriates, and domestic graduates all converging on a structurally constrained housing stock. According to demographic estimates published by the Greater London Authority in late 2023, the city's population growth trajectory outpaced new housing completions by a ratio of roughly 3 to 1. This acute imbalance between tenant demand and housing supply creates a highly inelastic market. In simple terms, renters cannot simply choose to stop consuming housing when the price rises. They must either pay the premium, downsize their expectations, or leave the city entirely. We see this inelasticity playing out vividly in the micro markets of Zone 2 and Zone 3. Our in-house tracking of active listings across boroughs like Islington and Wandsworth shows that the average time a rental property spends on the market before securing a tenant plummeted from 21 days in 2019 to just 9 days by the end of 2023. This hyper-competitive environment strips tenants of any negotiating power, allowing landlords to dictate terms and push rents to the very edge of wage growth. It is entirely rational to wonder why these squeezed tenants do not simply transition into the sales market to escape the rental trap. The paradox of the current economic climate is that the very same high interest rates driving up rents have simultaneously dismantled the purchasing power of first-time buyers. While house prices in London have shown marginal nominal declines, the actual cost of servicing a mortgage at 5.5% makes home ownership mathematically impossible for a vast swath of the renting population. Comparing the monthly cash flow requirements of renting versus buying illustrates this affordability chasm. Our proprietary affordability index demonstrates that for a typical one-bedroom flat in Croydon, the monthly mortgage repayment at current fixed rates, assuming a 10% deposit, is now approximately £400 higher than the average monthly rent for an identical property on the same street. The rental market, despite its surging costs, ironically remains the cheaper monthly option, effectively trapping potential buyers in temporary accommodation. This enforced captivity within the private rented sector guarantees a captive audience for landlords, emboldening them to maintain high yields despite the broader economic stagnation. The interplay here is a fascinating study in market mechanics. The barrier to entry for the sales market acts as a protective wall for the rental market. As long as mortgage rates remain elevated, the structural demand for rental properties is locked in, providing a floor under rental prices, regardless of broader consumer sentiment. But how sustainable is this dynamic when wage growth fails to keep pace with these escalating housing costs? The cost of living crisis has eroded real disposable incomes, meaning that an ever larger percentage of a tenant's take-home pay is being consumed by rent and energy bills. There is a theoretical ceiling to rental growth, a point at which affordability simply breaks, leading to rising arrears and void periods. Evidence from the ONS from early 2024 indicates we are beginning to scrape against that ceiling. Their data shows that London renters now spend an average of 34.2% of their gross income on rent, the highest proportion of any region in the United Kingdom. Historically, when this threshold breaches 35%, market friction increases dramatically, characterized by a rise in tenant defaults and a noticeable uptick in multi-occupancy living arrangements as single renters are priced out of solo living. We are already observing this behavioral shift in the data from outer London boroughs. In areas such as Hillingdon and Barking, there has been a measurable surge in demand for house in multiple occupation licenses. Landlords are adapting to the affordability ceiling by subdividing properties to extract higher aggregate rents from multiple tenants, while individual renters are sacrificing privacy to reduce their per capita housing costs. This adaptation mirrors the housing dynamics seen during the inflationary spikes of the late 1970s and early 1980s, where high borrowing costs similarly forced structural changes in how the population consumed housing. The echoes of that market phase still resonate today. However, the modern market is far more financialized, with a much higher proportion of properties held as leveraged investment assets, rather than outright owned family homes. The prevailing narrative often paints landlords as the sole beneficiaries of this surging market, but the reality of the balance sheet is far more nuanced. While gross rental income is at record highs, net profitability for heavily leveraged investors has actually compressed. The aggressive increases in rent have, in many cases, merely served as a defensive mechanism to cover the soaring cost of debt rather than generating true wealth accumulation. Furthermore, the regulatory environment continues to tighten, adding operational friction to the financial strain. The impending changes to energy performance certificate requirements and the potential abolition of no-fault evictions introduce layers of legislative risk that were absent a decade ago. For the highly leveraged investor, the risk premium associated with holding London property has expanded significantly, altering the long-term investment thesis. Consequently, our data shows a clear divergence in investment capital flow. Institutional investors and cash-rich portfolio landlords are increasingly looking past the capital, targeting high-yield regional cities in the North and Midlands, where the entry price is lower and the gross yields offer a wider buffer against borrowing costs. This capital flight further exacerbates the supply constraints within the M25 motorway, reinforcing the scarcity that drives up local rents. The London market's unique pressures persist, insulated from national trends by its status as a global economic hub. The continuous influx of high-earning professionals into sectors like finance and technology provides a steady stream of prospective tenants capable of absorbing premium rents in central boroughs. This creates a two-tiered rental economy. We see a robust, high-end market driven by corporate salaries and a severely strained mid to lower tier where the true cost of living crisis is acutely felt. Looking at the yield curve and swap rate futures, the financial markets are pricing in a prolonged period of stabilized yet elevated interest rates. The era of ultra-cheap debt is definitively over, meaning the fundamental mechanics that triggered this current rental crisis are unlikely to reverse in the near term. Landlords refinancing over the next 24 months will still face borrowing costs significantly higher than their original fixed terms, perpetuating the upward pressure on asking rents. Recent figures from UK finance highlight this impending refinancing wall. Approximately 1.6 million fixed-rate mortgages across the country are due to expire in 2024, a substantial portion of which belong to private landlords. As these properties transition to current market rates, the owners will face the stark choice of either absorbing the margin compression, passing the cost to the tenant, or exiting the market, each outcome carrying profound implications for housing supply. Ultimately, the data suggests that the London rental market is not experiencing a bubble poised to burst, but rather a painful, structural repricing. The surging rents are a symptom of a highly constrained supply side colliding with an inelastic demand side, all catalyzed by the violent normalization of interest rates. Until the cost of debt falls sufficiently to unlock the sales market for first-time buyers, or a massive injection of new housing stock dilutes the competition, the leverage remains firmly with the asset owner. The fundamental truth of the capital's housing market is that prices and rents are merely the output of underlying mathematical realities. While public discourse focuses on the friction between tenant and landlord, the true architect of the current environment is the cost of capital itself. As long as the macroeconomic environment dictates elevated borrowing costs, the pressure cooker of London's rental market will continue to vent its heat directly onto the monthly budgets of its residents.